By every operational metric, the methodology reads MongoDB looks excellent. Revenue at 2.46 billion trailing 12 months. Growth at 22.8% year over year. Operating cash flow at 505 million. Free cash flow at 500 million. Almost identical to the operating cash flow because MongoDB is a capital light software as a service business. Net cash 1.05 billion against 33 million in debt. That's a fortress balance sheet. The Occam score lands at 95 out of 100. It's a healthy tier. Rule of 40 at 43. Wall Street consensus across 33 covering analysts is 85% buy or strong buy, with an average price target of $368. 23% above where the stock trades today. By every signal the retail investors on the sell side use to mark a name as a buy, MDB looks like a buy. So why did the methodology return flagged? The forensic jury runs 4 independent AI lenses on the same source material. Same 10Q, same 10K, same earnings transcripts, same third-party financial data. Each lens has its own mandate. The auditor reads the books, the architect reads the words, the storyteller reads the absences, the sentinel reads the outside world. Each lens returns a verdict. The default merge is a weighted mean, but the architecture has one override. When any single lens returns flagged, that triggers a persona level override path. The merge stops averaging. The disagreement gets preserved as the headline verdict. MongoDB is the canonical case. 3 lenses return variants of cell. 1 lens return flagged. The single flagged is what shipped as a dossier. Here's what each lens actually said. The auditor's first move is cash flow. $500 million of free cash flow on $2.46 billion of revenue is a real business. The auditor's next move is valuation. The DCF intrinsic value lands at $123 per share. The market price at the run date was 301. Margin of safety is negative 59%. A common objection to this kind of analysis, DCF does not fit hypergrowth SaaS companies. 23% growth in the AI data tier should command higher valuations than a discounted cash flow model can defend. The auditor anticipates that objection, pulling an independent third-party DCF with a different set of inputs as a cross-check to the answer. The model landed at $191 per share, also below current market value. When 2 independent DCFs with different assumptions converge on direction, the objection that the DCF does not apply becomes harder to sustain. The price versus cash flow gap is the gap, regardless of which DCF you use. The auditor's verdict is a sell at medium confidence, not a strong sell because the business is fundamentally sound, not a buy because the price is wrong, very wrong. It's an excellent business. The problem is price. When that tension is structural and unreconciled, the methodology has a category for it. The architect reads management's disclosure language. What they say, what they hedge, what they leave structurally unaddressed. Architect's read on MDB is at the centerpiece of this dossier because the architect is the lens that flagged returned. Management language emphasizes cash flow viability. The 1.05 billion liquidity cushion, the fortress balance sheet, the runway. What it does not address is the gap between operational health score of 95 and the DCF verdict of a strong sell. The disclosure language never bridges that gap. The structural tension is what the architect lens flagged. Not a clean sell, not a confident hold, a flag. A signal that something in the gap between the methodology and management's pros is unaccounted for. The architect's verdict is flagged at medium confidence, triggers the persona level override. The storyteller reads what's not in the narrative. 4 absences on MongoDB. 1, no celebratory tone when the 22.8% revenue growth, 23% growth at this scale is genuinely impressive, and management presents it as an afterthought. 2, no explanation for the $71 million GAAP net loss against $500 million of free cash flow. 3, empty confidence factors and relative valuation sections. For a category leader like MongoDB, the absence of peer benchmarking is striking. No Atlas penetration numbers, no Victor search traction, no AI workload adoption metrics. In prior periods, Mongo led with those numbers. Now the narrative is silent. The storyteller's verdict is sell at high confidence. Now, the Sentinel reads the outside world. It cross-references everything outside the filing. The original Sentinel pass on this name surfaced independent third-party DCFs converging on overvaluation in the 60 to 90% range. It also surfaced an analyst upgrade flow that Sentinel framed as a sell signal for disciplined investors, not a buy signal. Two of the original Sentinel citations did not survive the methodology external verification gate. A C group attribution could not be primary source confirmed. A consensus number source from a retail platform subsample needed to be replaced with a broader 33% sell side consensus. The corrected Sentinel pass shifted from strong sell to sell after the citation fixes. The valuation conclusion was unchanged. Both passes, original and corrected, stayed on the public record. The Sentinel's verdict is sell with high confidence. MongoDB is one of the highest quality businesses in software. Revenue growing 23%, $500 million in free cash flow, net cash north of $1 billion. The methodology return flagged at high confidence on this name. Those two statements do not contradict each other. Here is why. A single model verdict on MDB would have averaged the 4 reads into a smooth sell, or worse, into a hold by weighing the auditor's medium against the higher confidence sell reads. The architect's structural objection that the business is excellent and this price is wrong and management is not bridging the gap would have been smoothed into a probability weight rather than preserved as a flag. The flagged override architecture is what stops that from happening. When any one lens returns flagged, the disagreement carries forward as a headline verdict. The structural tension stays visible on the public record rather than getting papered over with a numerical merge. This is what the methodology promises. That is what flagged status on MongoDB is a canonical example of. So what does flagged verdict mean for the reader? It is the methodology's category for the structural tension is real and unreconciled. Wait until the price moves toward DCF or management resolves the gap. Is different from sell at high, which says exit now. Is different from hold, which says no view. Flagged says the model and the pros disagree, and the disagreement is a signal worth watching. 3 things would change this verdict. The market price retreats meaningfully toward the DCF intrinsic value, or the auditor's growth assumptions turn out to be materially too conservative, or management's language begins to substantially defend the multiple. Any of those would resolve the architect's structural tension and lift the flag. I'm not telling you MongoDB is a sell. I'm telling you what the methodology surfaced on a name that scores 95 out of 100 on operational health and trades at a 59% premium to what an independent DCF can defend. Both reads are honest. The methodology preserves both. ODBC's stale data correction earlier this month, MDB's flagged override this week. The audit trail is the product. That's what makes this different from a sell-side research that reports a verdict and moves on.